Welcome back. We are talking smart investments this morning. Now, here's something to look out for. Phantom income. Now, many investment portfolios can expose you to it, and you'll end up with unexpectedly higher taxes. Jonathan McCoy, partner and lead advisor with Market Advisory Group, a financial services company, is here to help avoid that problem. That sounds horrifying, number one, something more maybe suited for a Halloween show. A lot of scary stuff out there when it comes to investing in taxes, but it starts with deciding how much to contribute to pre-tax requirements, your Roth IRA accounts, or both. How do I go about managing this phantom income?
Well, ultimately, phantom income has to do with primarily after-tax investment accounts. A lot of people may be inheriting assets from their parents or have other types of assets where they've moved money from bank savings to the stock market. And then you've got a broker or an advisor that's trading that account, realizing some of those capital gains that you yourself are not living on this year, so you don't see the income, but it's still occurring and being reported to the IRS inside of your portfolio, which can, we've seen it make people ineligible for the recent stimulus checks. And just the additional income tax in general could raise your tax rate on things like Social Security benefits or your ordinary income from work. You bring up kind of the ratio of pre-tax to Roth assets. That has a much longer term implication where we have to look at required minimum distributions. How much is the IRS going to tell you you've got to take out of that 401k?
God, man, it's like you're speaking, you know it all. And for me, I'm just, I don't know what to do with my income sometimes. And I have, different portfolios and people that I trust to invest it with, but it just can be scary times sometimes. It's just with these things we're not seeing on a day-to-day basis that can require and build up that tax, is a tax liability that would be called? Okay.
Yeah, ultimately.
Well, let's talk problems people are going to encounter when they have financial advisors that maybe don't or they can't give tax advice. What should they be aware of and how should they approach that situation?
Well, the hard part is what we find is most people are Googling a lot of these questions, right? Or just looking up on any kind of internet browser. What should I be doing tax-wise with my retirement accounts? And the unfortunate part in our industry is most financial advisors are not licensed to give this type of advice. At Market Advisory Group, we tie in our tax management team through Market Tax Services in-house at the same conference table so we can have that conversation all at once. We're not handing people the business card for a CPA to go talk to down the street. But come into our office, talk to us one-on-one. You'll have complimentary access to our CPAs to start looking at what does your tax situation look like 10, 15, 20, 25 years down the road? How does that evolve? How much money should you be putting into traditional pre-tax 401k versus, you brought up Roth, as the after-tax or tax-free side of your investment accounts? There are tax benefits to now and there can be tax benefits later, but you've got to weigh that balance and ultimately look at what is the IRS going to do with all that money.
And how nice to have that all under one rooftop, and especially that forward thinking, not just for this year's taxes or next year's taxes, but again, as you said, 10, 15 years down the road and those implications that can be pulled together as such. Well, we do get some phone calls and some questions for you guys. You guys have called in and give us questions. This one's coming from Ron M. Now he's asking about required minimum distributions or RMDs, like we talked about. He says, hopefully a person's 401k account will increase throughout each year. When you reach the age of RMD, at what point in the tax year does the IRS determine your balance to calculate that year's RMD account? Is it the first of the year, mid-year, or end year?
They're actually looking at the end of the year balance from the year prior.
Okay.
And then they look at what age are you attaining this year, and there's a divising factor in there. There's what's called the uniform life expectancy tables that are used to base and determine what your required minimum distribution will be for that year. And ideally, yes, your accounts are growing each year, but the problem is, as your accounts should grow, you're also going to get older and older, so the percentage you're required to take out of those retirement accounts gets higher and higher. And when we talk to folks that are in their mid to late 70s about tax management and retirement, these required minimum distributions are the one biggest thing that people are not looking at that leaves them completely out of control of their tax situation.
And then that amount just grows and grows year after year that you can be liable for. All right, well, Jonathan, thank you very much for your time today. If you have retirement questions or that you need answered, you can submit them to Market Advisory Group, and they may be answered on air. Just call 816-548-2000 or visit AskOurAdvisor.com. If you include your address, Market Advisory Group will send you a free gift.